PayPal is down 10% today after it reported its earnings. Many investors have been saying this is a deep value stock that is trading at a low price to earnings ratio while still growing its fundamentals. It's also one of the most requested stocks to look at here on my channel. So today, I want to go through PayPal's earnings report and give you my updated thoughts on the business. In this video, I will share if PayPal is looking cheap and explain if I am going to be buying the shares or continue to pass on it. Before we get into the video though, I just want to let you all know that my book, The Fundamentals of Investing, is officially available on Amazon. Thanks to so many of you ordering the book already, it has become the #1 bestseller in the stock market category on Amazon. So if you're interested in learning more about fundamental investing and learning how to find stocks that can compound your wealth over the long term, then consider checking out my book. And with that being said, let's dive right into the video. And as always, I put together a little bit of a Daniel Pronk slideshow for you guys on PayPal's most recent earnings report. So let's dive right into it. Here we can see that the fourth quarter revenue did increase by 9% year over year to $8 billion. And for the full year, PayPal's revenue did grow by 8% to $29.8 billion. So PayPal's revenue overall is still growing. And personally, I do think that this is a great thing to see because it means that PayPal's overall business is still growing. Then the CEO said down here, "We are committed to making the necessary changes to our business to drive profitable growth in the years ahead." I like that the CEO is saying this because, as I have said previously on my channel, one of my main concerns with PayPal is the profits are not really growing with the revenue. And if profits are not growing with revenue, then the increased revenue does not create any shareholder value. So I really want to see the company continuing to grow its profits too. So let's see if PayPal has managed to do that. Again, we can see here that net revenues did grow by 9%, transaction margin dollars of 3.7 billion, which is flat on a year-over-year basis. So transaction margin is not really growing. GAAP operating income, though, did increase by 39%, which is significant. GAAP operating margin also expanded 4.68% to 21.5% year over year, which is pretty significant as well. GAAP earnings per share also increased by 61% to $1.29. Now, I do know that PayPal has had some weird financials going on with their GAAP financial reporting, so I am actually going to focus on the non-GAAP and adjusted figures year over year because PayPal does kind of normalize the figures in their non-GAAP numbers. So that is what I'm going to be focusing on in this video. But moving on, for the full year, transaction margin dollars actually decreased by 1%, which is not great to see. GAAP operating income also increased by 31% for the full year, and GAAP earnings per share increased by 84% for the full year. Now, fourth quarter operating results. For the fourth quarter of 2023, total payment volume increased 15% year over year, which is significant as well. Q4 payment transactions also increased by 13%. Payment transactions per active account on a trailing 12 months basis increased 14%, and active accounts decreased by 2%. Now, that last point is something that I also personally do not love to see because PayPal has been seeing its active accounts decline quarter over quarter for about the past year now. And the reason that I do not like to see this is because if PayPal's active accounts are not growing or their user base is not growing, then basically for the business to continue growing its revenue and profits, it means that it has to continue sucking out more revenue and profits from its existing users. This also means that PayPal is very incentivized now to continue increasing their fees on their existing customers. Now, at some point, I do think that there is going to hit some limit where PayPal's customers start leaving the platform if they start charging too many fees on their existing customer base. Basically, what I'm trying to say is there is a limit now to how much I think that PayPal can actually grow its revenue and its earnings before it starts to see a decline in its customer base at an even more significant rate. But overall, right now, the business's strategy is working because their customers are using PayPal more. Again, payment transactions per active account on a trailing 12 months basis did grow 14%. So the people on PayPal seem to be using PayPal more, and that is what's growing PayPal's revenue. Now, if we move on to cash flow, we can see that for the full year, cash flow from operations was $4.8 billion and free cash flow was $4.2 billion. Now, this is actually down year over year, which we are going to see here in a minute, but PayPal's overall cash flows are declining still, and we're going to dive into that more. Further down here, it says that PayPal bought back $5 billion worth of shares during the year as well, and repurchased about 74 million common shares, which is good to see. So far in this report, what I have seen is revenue is growing, transaction volume is growing, people are using PayPal more, active accounts is going down though, and free cash flow is going down. So a little bit of a mixed report so far. Now, if we get into PayPal's financial guidance, take a look at this. Net revenues are expected to increase approximately 6.5 and 7% for the first quarter of 2024. So PayPal is expecting its revenue to continue growing by about 6.5% over the next 3 months, which overall is a good thing for the business. Non-GAAP's earnings per diluted share are expected to increase mid-single digits, which is about 5% in the first quarter as well, which is good to see because earnings per share, that means, is going to grow with the revenue, or at least at a little bit of a slower rate. However, for the full year of 2024, PayPal says GAAP earnings per share is expected to be approximately $3.60 compared to $3.84 in the prior year. So GAAP earnings per share is actually projected to decline in 2024. This is not a great thing to see, especially if PayPal is expecting its revenue to continue growing throughout the remainder of the year. Non-GAAP earnings per diluted share expected to be in line with $5.10 in the prior year. So on a non-GAAP basis, on an adjusted basis, PayPal's earnings per share is not projected to grow in 2024. This once again means that PayPal's profits are not going to grow, or they're not projected to grow in 2024, despite the revenue growing, which again is one of my main concerns with this business, is its revenue grows, but its profits are not really going up. And that is really the problem that I see here. Now, if we take a look at another summary here at the non-GAAP results, which is what I'm going to focus on, we can see operating income on a non-GAAP basis was up 14%. The operating margin did increase by 1%. Net income did grow by 18%. Earnings per diluted share did grow by 24%. However, free cash flow and adjusted free cash flow, which are the metrics that I focus on, did decline by 17% and 11% year over year. So PayPal's overall cash flows are not growing year over year, despite the revenue growing 8%. Now, if we head over to the cash flow statement, another thing that I do not like about PayPal is its stock-based compensation, in my opinion, is very high. For the trailing 12 months, or for the full year of 2023, stock-based compensation was about $1.5 billion. Now, we can see net cash provided by operating activities for the year was $4.8 billion. This means that stock-based compensation was about 30% of overall operating cash flow. That is a lot of stock-based compensation, especially when the stock is down and it has not produced any shareholder returns and the business's profits are not really growing. For example, in 2022, PayPal did $5.8 billion of operating cash flow. So year over year, operating cash flow has declined by 17%. The stock is down significantly from its all-time highs, but insiders are still making billions of dollars and they're getting rich. So that to me is a red flag, and you guys know me. I really like to see low stock-based compensation on the businesses that I own, and in my opinion, PayPal's stock-based compensation is too high. Now, moving on to the next screenshot right here, we can see that PayPal's CapEx was $623 million, which gives us that $4.2 billion in free cash flow for the year, which is a decline of 11% year over year. We can then see that PayPal repurchased $5 billion worth of stock over the past year, which is what they said. However, this is more stock buybacks than the company generated in free cash flow. So they're buying back even more shares than the company is generating in free cash flow. And straight up, I do not think that this is actually a red flag right now, because PayPal does have a lot of cash on the balance sheet. But overall, what it means is they're probably dipping into their cash position to continue buying back more shares. Again, this is not really a problem. All it means is that if PayPal cannot grow its profits and its operating cash flows, then this level of share buybacks is unsustainable because it is dipping into the company's cash position. Now, moving on, this table right here shows us where PayPal's revenue growth is coming from and where its overall revenue breakdown is, or what its revenue breakdown looks like. So right here, PSP is now PayPal's largest business, which makes up 35% of its overall revenue, and this area of the business is growing at 30% year over year. This is actually great to see because, again, this is the largest area or segment of the business, and it is growing the fastest. So that is overall where the business's majority of its growth is coming from. And then right here, it says PSP is unbranded card processing, primarily comprises Braintree full stack volume. So this is Braintree right here. Now, people know that Braintree is a low margin business for PayPal. It's not a very profitable business, at least not yet. So this kind of makes sense as to why PayPal's overall revenue is growing, but its profits are not really growing because, again, Braintree is not a very profitable business. Now, if we head over to PayPal very quickly here and we go and take a look at its financials on Stock Unlock, and we take a look at the revenue, here we can see that PayPal's revenue is continuing to grow. The revenue is at an all-time high. This overall is a great thing to see. Now, if we go and take a look at PayPal's cash flow, though, which is my preferred metric, as I said, we can see that it has not really grown since 2018. Back in 2018, the company did about $4.2 billion in operating cash flow. They did about $4.8 billion in 2023, which is not really that much growth over the past 5 years now. So again, PayPal's profits are not really growing with the overall revenue. And if we take a look at PayPal's metrics right here, the number that I want to focus on is the blue line, which is PayPal's gross margin. In 2015, PayPal's gross margin was about 53%. Now it is sitting at about 40%. So PayPal's gross margin is actually declining as the business grows, which is offsetting the overall profit growth. This again is most likely because PayPal's revenue growth is coming from Braintree, and that is a low margin business. So as Braintree continues making up more and more and more of PayPal's business, we are seeing its gross margin decline. However, I also know that gross margins declining over time can suggest that a business does not have a durable moat. That is also one of the things that I am concerned about with PayPal, is there is just a lot of payment processors out there in the world, and PayPal is having to compete against them. And over time, it does look like PayPal's gross margin is declining, maybe from competition, maybe from Braintree, maybe a mixture of both, but overall, it's not a great thing to see. And again, a declining gross margin can be a sign that a business does not have a durable moat. When we also couple that with the fact that PayPal's cash flows are not really growing with the revenue over time, maybe it is a better argument that the business does not have a durable moat right now. So now let's discuss PayPal's valuation. Well, the business is currently selling for a market cap of $68 billion today. So if we pull out our calculator and we go $68 billion divided by $4.2 billion in trailing 12 months free cash flow, this means that the business is now selling for about 16.2 times free cash flow. And this is not an astronomical, insane price ratio. We're not talking about 40 times free cash flow right now. It's really reasonable at 16.2 times free cash flow. However, again, PayPal is not projected to grow its earnings, and I doubt it's going to grow its cash flows in 2024. So basically, you have to ask yourself, what price multiple would you pay for a business that is not really growing? And for me, I do not want to pay a 16 price ratio for a business that is not growing. I am actually finding stocks in the market that are selling for cheaper price ratios and growing their revenues, earnings, and cash flows at double-digit growth rates. So it doesn't make sense for me to want to buy PayPal at a 16 price ratio when I can find better investment opportunities out there that are cheaper and growing faster. So that is what I try to do as an investor, is whenever I'm looking at an investment, any new investment, but in this example, we're using PayPal. So when I'm taking a look at PayPal, I'm looking at a 16 price multiple for a business that's not growing, and then I have to compare that versus the other investments that I currently see in the market. And for me, again, I do find better investments out there than PayPal. So I do not, personally, I'm not attracted to PayPal at this price. It would have to fall significantly more for me to want to be attracted to it or consider it, because there's just better investments out there. Now, additionally, what we have to consider is that stock-based compensation eats up 30% of PayPal's free cash flow. So we should actually multiply this by 1.3, which is a 21 price ratio if we want to factor in the stock-based compensation. But even if we do not factor in the stock-based compensation and we go 100 divided by 16, this means that PayPal has a 6.25% free cash flow yield on cost. So let's just remove stock-based compensation from the entire equation. What this means is that if PayPal wanted to take 100% of its free cash flow and pay a dividend or buy back shares, then it could repurchase about 6% of its shares on an annual basis or pay out about a 6% dividend yield. That's if it used 100% of its free cash flow. So this is the max return that PayPal can deliver to its shareholders. And again, the business's free cash flow is not really growing. So when I am looking at what the business behind the stock can generate for me as an investor, it's about 6% right now. Again, I am finding better investment opportunities in the market right now than a 6% yield that is not really going to grow over time. It's better than a bond, but it's not really growing over time. And this is not factoring in the stock-based compensation, which is going to dilute shareholders and offset buybacks. So that is kind of my quick thoughts on PayPal and its most recent earnings release. I do understand why people think that the stock is looking cheap right now. If you're taking a look at a price to free cash flow basis of 16, you compare that to the company's history, it does look cheap relative to history, but relative to what the business is actually producing today and what it is projecting to produce over the next year, it's really not that attractive of a valuation and as a stock, in my opinion. So that is my thoughts on PayPal. I do hope you guys enjoyed this video. If you did, then please remember to leave a like on the video. And if you're new here, then consider subscribing to my channel as well. Also, if you are interested in learning more about investing and fundamental analysis like I do here on my channel, then seriously go and consider picking up my book, The Fundamentals of Investing, which is now available on Amazon. It really is a great book, and whether you are a new investor or a seasoned investor, I can guarantee that you will learn something new. So seriously go and consider checking out my book on Amazon. And with that being said, thank you all so much for watching. As always, I truly do appreciate it, and I really hope to see you all again in my next video. Very quickly, I do believe the next video should be on Brookfield, which did just report their earnings today and is the largest position in my portfolio. So if you're waiting for the Brookfield results, that will be the next video. Hopefully I will get that out tomorrow. But I'm going to stop rambling now. Thank you all so much for watching, and I hope to see you in tomorrow's video.